Hooty hoo, all my stock market gamblers. Welcome today. It's Monday, April 19th. Markets are open. The week is off to a not so positive start. The Dow is down about 100. NASDAQ down about 100 also. Markets only go up. We all know that. They only go up, right? I mean, they've only gone up. We've been in this bull market 12 years now, 12 years. It's a nice run. Okay, what I want to talk about today a little bit is the risk to the reward. Right now we're in a market that is in a bubble. Now, how do I know it's in a bubble? Let's talk about this a little bit. There's what's called as the Buffett Indicator. The Buffett Indicator basically states the total market capitalization of the United States stock market, which right now is about $42 trillion. So $42 trillion over the gross domestic product, which is the GDP, which is about $21 trillion. So 42 over 21 is 2 for 1 or 200%. The Buffett Indicator has never been at 200%. Okay, this is very expensive. Warren Buffett would probably be calling for a crash soon. He'd have to, according to his indicator. This is the indicator he makes famous because this is what he uses. He says over 100% is expensive, below 100% is relatively inexpensive. Okay, so the Buffett Indicator is over 200% for the first time ever. In this month of April, it hit over 200%. That's crazy. That's crazy expensive. That is a huge bubble. Now, historically, the Buffett Indicator runs about 85%. Total market capitalization over the gross domestic product is historically about 85%. Now, once again, I want to go over this again because it is important. Okay, right now, the total market capitalization of the U.S. market is $42 trillion. Okay, the total GDP, now this is the government figures, I'm not sure I agree with it, is right around 21 trillion. Now, the reason I say I'm not sure I agree with it, in 2019, we're a little above 21 trillion. In 2020, we're just a little below 21 trillion. Basically, the pandemic has done nothing to the GDP declining. We got 20% of people staying at home collecting unemployment checks, but the GDP didn't drop. Makes me suspicious. I think it did drop. I think it dropped quite a bit. But we'll go with their number. With their numbers, right around 21 trillion. Okay, so 42 trillion total market capitalization over 21 trillion for the GDP. 200%, 2 to 1. Never been this expensive ever. Okay, and historically it runs about 85%. Okay, what if we go back to the historical mean? What does this mean for the stock market? Well, it would mean at least a 60% crash. 60% crash from where we're at right now. Now, we've overshot to the upside. What if we overshoot to the downside? Probably get closer to an 80% collapse. Now, is it going to happen tomorrow? No, that's the million-dollar question, right? We don't know where this is going to happen. We don't know if it's going to happen today, next week, a year from now, 10 years from now. We don't know. These things can take time to play out. All we know is that we are in a very expensive bubble. Now, let's take a look at the GDP again. They're saying 21 trillion, right? Well, how much money is the government spend each year to get to that 21 trillion? I got news for you. It's about 50%. Almost 50% comes from government spending. Now, what do I mean by government spending? Well, they collect taxes from us and they spend that money into the economy. They print money, about $5 trillion a year right now, and they spend that money into the economy. The Federal Reserve, they're at about 7 or 8 trillion right now, buying up everything in the economy. This is how they get the GDP up to 21 trillion. They're responsible for about 50% of it. It's never been that high high ever. That's not normal. That's not normal. Because where does the government get the money from? They get it from you and me. They get it from the private sector. So if the private sector is only making 50% of the GDP, but they got to cover the government also, this is not a good scenario. This is not going to end well. What do we make in the U.S. anymore? Give me some concepts of what we make. I guess we still build houses, don't we? Yeah, we build some houses, okay. What else do we make in the United States? Everything else we pretty much import, right? We import everything. Our trade deficit is crazy right now because we import everything and we ship out nothing. Well, one thing we do ship out, we do ship out dollar bills. We ship out dollar bills because that's what we're good at doing. We're good at printing the money. Actually, we don't even print it anymore. It's not a printing press. It's digital. Okay, so they can do $1 trillion with the click of a button on a computer. They can do $1 trillion like that, which is really impressive to me. I mean, we just print $1 trillion. Let's print $5 trillion. It doesn't seem to hurt anything. Let's print $10 trillion. We might print $10 trillion. We might do it this year. We've already got $2 trillion for the stimulus package. We'll probably get another $4 trillion infrastructure, and I bet by the end of the year we're going to need another stimulus package. That'd be close to $10 trillion just in new money coming online, right? What does that do to your dollar? Shrinks the dollar. Dollar's just going to go low. It's going to get crushed. You're going to go $50 loaf of bread, $10 gallon of gas. Dollar's getting slammed today. Take a look at the dollar today. Getting slammed hard. Okay, so back to the Buffett indicator. This is Buffett's own indicator. It is at a record high, and it's never been above 200%. Okay, so do we think it can get to 300%? I do not. That would put the Dow at 50,000, and I don't know if we'll get there. We might print that much money. You see, right now we have that buy the dip mentality. Today we're getting a little dip in the market, so people come in and they buy this dip, hoping the market goes higher, hoping it sets new record high, and it probably will set a new record high, probably set a new record high this week. But the risk to reward is getting a little bit stretched here. We got the Buffett indicator screaming. He's screaming that it's a bubble. It's a bubble. It's going to drop 60%. Now, that's fine with me. I don't mind when the market drops because I can play both ways to the market. Now, a lot of people that have the 401ks, a lot of the pension funds, they can't short the market. They're dependent on the market to go up. But the market is so far stretched with all the money we printed that the market at some point is going to go down. Now, is it imminent? It could be right around the corner. I've never seen 200% ever on the Buffett indicator. But I'm going to make a lot of money when the market goes down. But it's not ready to go down just yet. How do I know that? Well, I'm a chartologist. I look at charts. Everything is still in an upward trend. Do not bet against the trend. Do not bet against the Fed printing the money. They're going to print more money. I guarantee you they're going to print more money. So we're probably still in the uptrend from here. But once the charts start to break, how do I know when the charts start to break? SPY, the QQQ, the DIA, once those get down, all three of them, below their 50-day moving average, then we're in a lot of trouble and we might see that 60% crash happening. But right now, all three of those indicators are well above their 50-day moving average. They're well above the 200-day moving average. They're well above the 20-day moving average. They're above all the averages. The trend is up, and you do not bet against that. You don't short the market right here. I am not saying to short the market. I'm saying to watch the trend. Watch where the SPY is. Watch where the QQQ is. When they break below the 50-day moving average, then we're in a lot of scary times, a lot of scary trouble. The market's scary now. It's a bubble. No doubt about it. We're in a bubble, and that's scary. But the trend is still up. The Fed is still going to print a lot more money. So we are going to get more record highs from here. I do believe that. So right now, we do want to buy those dips when it drops. We do want to buy those dips. But I'm telling you, it's going to change. See, millennials, I hope you're watching. I don't know if I have millennials watching. I'm an old guy. They call me a boomer, right? Isn't that Okay, boomer. Well, us boomers, we've seen the market drop before. You millennials, you're under 30 years old, you've never seen the markets go down. And when they go down a lot faster than they went up. They come down hard. They come down really hard. Look at okay, take Bitcoin, for example. It dropped 10% just over the weekend, right? That was nothing. Bitcoin could drop 80% over the next weekend. I'm not saying it will. I am saying at some point, Bitcoin will drop 80%. It's already dropped 80% at least 5 times in the life of its 10-year history. Okay, but the market can drop just as fast. It can collapse. Stairs up, elevator down. Just be careful out there. We're getting stretched in the valuations. The Buffett Indicator, 200%. Never seen 200% on the Buffett Indicator. This tells you we're in the bubble. But don't bet against the trend. Don't bet against the Fed. They're both telling you the market's going higher from here until it's not. And if you subscribe to this channel, I'll let you know when the trend changes. I'll let you know when we're going to get that downward drift. And it might not just be a drift, it might be a snowfall, a free fall. Okay, if you like this stuff, give me the thumbs up. I want to talk to you again later in the week. Stay with me. Give me that thumbs up. Hit the subscribe button. I'm Tall Mike. Get out there. Have a great Monday. We'll talk again soon. Bye-bye now.